Hey guys, JC Parets here, and welcome back to Pardon the Price Action. I am joined by Steve Strazza. Let's get right into it. So we finally got some action the past couple of weeks. What are we making of the recent run-up in interest rates? Is it real? See what I did there?
Yeah, so it's actually really nice. We finally got a resolution in something. For the past 6 months now, we've been talking about really important levels and some really important charts, and up there as high as anything was 1.4% in the 10-year yield. We finally cleared that level at the end of last week, and we've seen some tremendous follow through this week. But we're also seeing other things fall into place that would confirm this move in rates. We're seeing breakouts across the yield curve. So the 5 is breaking out, the 10 is breaking out, the 30 is breaking out. Our intermarket ratios are confirming what we're seeing from the 10-year. So by that, I mean regional banks are working. Equities for rising rates are working. Energy stocks are working. So it kind of seems like everything's clicking for rates right now. What do you think?
I think there's no doubt about it. I mean, when we talk about the most important charts in the world, rates have been right at the top. You absolutely nailed it, because the bond market is so massive that what happens there is going to have implications across asset classes. And if interest rates are going up, regional banks are confirming that. You know, we're going to talk about some of the higher dividend paying sectors in a minute, but what's happening is that you're seeing stocks saying that rates are going to go up, commodities saying rates are going to go up, and now the bond market is finally agreeing. That's what it looks like to me.
Yep. Yeah. I could not agree more. Next topic. So one theme that we've harped on for months now is the inability of breakouts or breakdowns to hold. We're seeing more of that this week. Are you surprised at all?
I mean, it's hard to be, right? Like, I feel like every time we see it, like, it's like, oh, another whipsaw, another failed breakout, another failed breakdown. But I guess it just reiterates that we're still in this messy market for the most part. We're seeing rotation underneath the surface. But like I said, like, look at semiconductors failing to hold the breakout. Industrials failing to hold the breakdown, right? You saw the same thing in transports that are within industrials. So it's more of rotation versus implosion, and that's what that rotation underneath the surface says to me. So it's not the laggards that are leading to the downside and then the leaders catching down. It's the rotation into the laggards and out of the leaders, and that's what continues, which to me ultimately that points to an upside resolution for stocks broadly speaking. That's what it says to me.
I think that's a great point. So basically, we're seeing the leading areas fail at the top of their range, so they're remaining range bound, and then we're seeing some of the weakest areas make nice saves and dig in at support at the bottom of their ranges. So it's exactly what you would expect in a environment where the indexes themselves are range bound, right?
Right, which if you've only been looking at the NASDAQ and the S&P, you might not see that, but you look at small caps, value line indexes, right, the median stock, you're going to see the majority of them churning. All right, next topic, what safety trade? Equities have been in a volatile ride for recent weeks, some more than others, but where's the bid for defensive assets? Nobody wants these things, huh, Mr. Strazza?
I mean, so coming into last week, we had some selling pressure that seemed like it was kind of like an indiscriminate sell-off. And we looked under the hood at some things, and it did not have nearly as much of a risk-off tone as the selling pressure felt like at the index level, right? So there were groups like semiconductors, a lot of cyclicals, home builders that were all higher. And then when you look, utilities were some of the worst performers. Utilities are down, 15 out of 16 sessions or something crazy like that. That is not characteristic of a market that's experiencing any sort of significant drawdown. During periods of drawdowns, you would expect utilities to be doing the least worst.
Yeah, I'm with you. And then you look at precious metals, you would expect some sort of defensive rotation there. You know, you're not seeing it at all. You're seeing all new relative lows. Look at Japanese yen just getting absolutely slaughtered. So here we're looking at dollar yen. So if you flip this upside down, that's what the yen looks like, getting absolutely slaughtered. And not to mention that discretionaries are breaking out relative to consumer staples. You know, to me, that's the biggest chart. You want to talk about, you know, risk on versus risk off. If discretionaries versus staples are above their Q1 highs, you got to be buying stocks. The bearish argument starts there, in my opinion.
So yes, to be clear, not only are defensive assets going down and making new lows on a relative basis, But at the same time, offensive assets are making new relative highs. Doesn't get much more bullish than that.
On an equally weight basis and cap weighted.
Yeah, across the board, even mid-cap discretionary versus staples, new all-time highs. All right, Hall of Famers. It's been a while since we dropped a new bottoms-up scan. I've certainly missed them. What did you think of our first edition of the Hall of Famers?
Listen, I'll take credit for this one. I like to give credit where credit's due. It's usually somebody else like yourself or maybe Grant or one of the fellas or whatever. I'll take credit for this one. You know, I thought we really needed to organize the mega caps better. You know, we were looking at 90% of these in different scans and in different workbooks, but we didn't have them as organized as this. And boy, it's been a grand slam. Everybody loves them, myself included. It goes back to, you know, we do things selfishly. We do things that we think are valuable, that we think are cool. And as it turns out, people agree. And it's 3 reasons. Number 1, you're looking at the biggest 100 companies in America. That's good information. Number 2, you're going to find trade ideas just by looking through those names. And number 3, it's an options trader's, you know, dreamland. I mean, just liquid options across the board, opportunities everywhere.
Yeah, I agree with everything you're saying. And then another thing that I'll mention, which, you know, I've been, you know, mentioning all week, but this kind of filled a nice gap for us because our other scans are a little bit more specialized. And this one, like, the beauty is in how simple it is, right? Because we're just taking 100 largest stocks, overlaying our technical filter so that the best ones pop out. Our other scans, we're filtering out stocks where we have criteria based on market cap, where we're only looking at stocks that are below a certain market cap. This one's not doing it. So it's really covering a universe of stocks that we might have been missing. Not that we usually miss any of these big guys, but it's nice to now have a slide deck and be looking at them every other week. So
I like Lowe's. If Lowe's is above 211, buy it. It's going to 300. Only above 211 because that puts it above the Q1 highs. If we're not above the Q1 highs, you can't own it. But if we are, there's your discretionary staples situation. You know, you own Lowe's, $142 billion retailer. We're all familiar with it. I'm like a dad now, so I go there now. That's kind of my thing.
Next topic.
I went there once. All right. I went there twice, actually. It was a beta chase the whole way up last year and early into this year. High beta was the leader. And then that stopped literally at the same time that stocks stopped going up. You know, that stopped in Q1. The majority of stocks peaked then. It's been breadth deterioration ever since. Is high beta back?
High beta looks as good as any factor right now. Growth and value are kind of battling it out. Value starting to perk up, but high beta looks great again. And just like we talked about, it was a beta chase. Beta is what was outperforming on the whole way up. So I think if we get a breakout in that high beta, low volatility ratio, that would suggest higher prices and potentially a new fresh leg up for equities more broadly. So I think that's a really important ratio chart to be paying attention to right now.
And I love comparing it to the value line index, you know, really sort of the median stock price change really gives you a good idea. Kind of like when you look at the small caps or the micro caps, you know, it really shows you that stocks have really struggled since the first quarter of this year. And it's not a coincidence that that's when high beta stopped outperforming. So if we're going to get that rotation back into high beta, you know, to me, how do we not take that as constructive? Not just for equities, but for risk assets. You're seeing it everywhere else. You're seeing it in credit spreads. You're seeing it in Aussie yen. You're seeing it all over the place. So it's not just a strength in high beta. I think you're seeing interesting rotation and lack of that defensive bid. This is the opposite of defensive bid, right? To, you know, come full circle with that last conversation.
Yeah. I mean, just to add to that point, like you said, this all comes full circle. What is high beta? It's energy, it's financials, it's all the stuff we were just talking about. So it's really the same trade.
All right. First thought.
So this is a game that we like to play where we say the first word that comes to mind. And today's phrase is head and shoulders.
Well, I'm going to put a combination of words and say when it doesn't confirm, right? When they fail, when they don't reverse. You know, for me, head and shoulders is when the best head and shoulders are when it's not that. You know, head and shoulders traditionally is a reversal pattern. I like when they're continuation patterns, and the beauty of it is that markets trend. We know that market returns do not fall under a normal distribution. We know for a fact that they trend. So when you're looking for reversal patterns, you're essentially defeating the entire purpose of what we're trying to do in the first place, which is identify primary trends, which is why when these reversal patterns don't actually turn into that, but in fact are just continuation patterns, those are the best ones. So if you identify the neckline, that's your support. As long as you're above that neckline, buy it all day, baby.
So when a head and shoulders reversal pattern doesn't work, that doesn't mean technical analysis doesn't work.
It means your technical analysis didn't work.
Fine. All I would add to that is they're just bases. I don't care if they have shoulders or not, or the nice head or whatever. It's a base. Bases come in all shapes and sizes. I wouldn't discriminate on it just because it's not a perfect looking head and shoulders. I mean, you have people talk about an inverse complex head and shoulders. I mean,
Right.
People, these are just bases, and the bigger, the better. That's all
Right.
I have to say about head and shoulders.
Yep, totally with you on that. All right, 2-minute drill. Oil above 100. What's
What a
that world look
headline.
like?
Oof. We are seeing energy sensitive assets really take on a leadership role across asset classes, right? So you're seeing energy futures really kill it. Energy stocks have been the leaders across pretty much every single time frame, even the trailing 12 months. Might not feel like it. Energy stocks are on fire. They're just catching a bid again. Their near-term leadership once again. Rates are putting a nice bid in that area. You're seeing it. There's the explorers and producers. I think it's hilarious. A sentiment indicator that we like to follow is the listing and delisting of ETFs. So we have unconventional oil and gas, which is ticker symbol FRAC. That's being delisted either next month or the month after, I know, sometime soon. And what we tend to see when an ETF gets delisted, it's usually a good time to buy it or buy those stocks. So we thought that was really interesting. But you can even look across, look around the globe, and we're seeing energy countries really lead too. You know, those oil-centric countries such as Saudi Arabia, Russia, Qatar is another great example. So I just think it's kind of all coming together for energy stocks right now, and there's a lot of opportunity right, you know, in that area. That's where we want to be focused for long opportunities right now, I think.
There's no doubt about it. And if crude oil breaks above 76 and we really get going, when you look at the CRB index going out at new 6-year highs, you ask yourself, why are bonds getting crushed? Why are interest rates continuing to make new highs? 10-year and 5-year, 30-year, you know, really interesting stuff happening in interest rates. Why? Yep. You know, CRB index making new 6-year highs. That's one answer, right? Crude oil. If that breaks out above 76, I think you're looking at $100 real quick. And the beauty of it is that some of these names, they don't have the market caps of these massive tech companies. These are tiny little mid caps, you know, and smaller size large caps. Look at LNG, look at Magnolia, MGY, look at Range Resources, RRC. And like we've been talking about all week, it's the explorers and producers, not some of those other areas, but specifically those. And with your fundamental expertise, you tell me it's because they're so leveraged towards the price of oil. So that's good enough for me, but I'll let price dictate my actions.
And we're seeing nat gas stocks perform really well too. So it's broad based, you know. Final word?
I wanted to talk a little bit about yoga. I think for everybody, not just traders and investors, but, you know, really humans, you know, just get a good stretch. And I used to think that if I didn't get a 45-minute or 60-minute yoga session, what's the point? And that was just wrong. You know, get down on the floor 5-10 minutes. I think it really goes a long way, and a little tiny bit compounds a lot over time. So I was mistaken. I was wrong. Doing anything less than 45 minutes, 60 minutes is perfectly fine. It doesn't make you less of a man or anything. You know, whatever stupid thing you want to convince yourself. 5-10 minutes. It's great.
Is this your atomic habit of the month?
No, actually, but I have kind of been doing that more lately after I read that book. I didn't do that on purpose, though, but it's funny. Maybe.
Good book. I would just like to say it's nice to have sports back on. This weekend was lovely. The Ryder Cup is like the Super Bowl of golf or the Olympics of golf. They only have it once every 2 years. It was awesome. Just fantastic. It always is, but USA won this year, took the cup back for the first time in about 6 years. That was really cool. Got a lot of really good young players on Team USA. Basketball's coming back. Hockey's coming back. I was watching Rangers preseason last night. I'm going to a Hurricanes game tomorrow.
Oh, yeah.
So, yeah, I'm psyched. Psyched for sports to be back.
Good for you.
To be allowed to go and watch.
Well, Mr. Strazza, thank you once again for joining me. Thank you all for tuning in to Part in the Price Action. I am JC Parets, joined by Steve Strazza, and we will see you next time.